Hello and welcome back to Pragmatic Finance. Today we are breaking down the Q2 results of India's two largest private banks, HDFC Bank and ICICI Bank. In simple, easy to understand terms, we will look at what the numbers mean, explain key banking terms and discuss how these results impact your investments. Before diving into the numbers, let's understand why bank earnings are so important. Banks sit at the center of the economy. When they lend more, businesses and consumers borrow more, fueling the growth. Strong bank profits signal a healthy economy. Weak profits can be an early warning sign. Now let's look at HDFC Bank's results first. HDFC Bank Q2 highlights. Net profit up 11% year-on-year basis. HDFC Bank reported a net profit of 18,641 crore rupees, up 10.8% from last year. Net profit is the bank's bottom line earnings after all expenses and taxes. Net interest income (NII) plus 4.8% year-on-year to NII rose to 31,552 crore rupees. Net interest income is the difference between interest earned on loans and interest paid on deposits. Net interest margin NIM 3.27%. NIM fell from 3.35% last quarter to 3.27%. Net interest margin measures how much profit a bank makes on its core lending business. Why it matters? When deposits rates rise faster than loans rates, this margin squeezes, reducing profitability per loan. Strong deposit growth versus loan growth. Deposits grew 12.1% to 28 lakhs crore. Loan grew 9.9% to 27.7 lakh crores. Banks have extra cash that earns lower interest. Excess deposits mean banks have extra cash that earns lower returns if parked in government bonds, further squeezing NIM. Asset quality improves. Gross non-performing assets fell to 1.24%. NPA is a loan on which the borrower has stopped making interest or principal repayment for 90 days. Lower NPA means fewer bad loans, signaling a healthier loan book. Provisions up 30% year-on-year. HDFC set aside more money to cover potential bad loans. Now we will look at ICICI Bank Q2 highlights. Net profit plus 5.2% year-on-year. ICICI Bank posted 12,359 crore in net profit, a steadier growth compared to HDFC but still positive. Net interest income 7.4% up year-on-year. NII rose 21,529 crore, showing stronger core leading profit growth. ICICI's NIM was 4.30% higher than HDFC's, indicating better lending spreads. Loan and deposit growth. Loans up 10% to 14.1 lakh crore. Deposits up 7.7% to 16.12 lakh crores. Healthy loan growth keeps interest income rising. Asset quality gets better. GNPA improved to 1.58%. Net NPA to 0.39%. ICICI's NPAs are slightly higher than HDFC's but trending lower. Operating profit and ROA. Core operating profit rose 6.5% to 17,078 crore. Return on assets shows how efficiently a bank uses its assets to generate profits. ICICI's ROA was 0.36%. Provisions and capital. Provisions were stable, indicating no sudden stress. Capital adequacy ratio at 17%, well above regulatory minimums, meaning ICICI has enough capital to absorb shocks. Now we'll look at comparative insights. NIM pressure. Both banks face margin compression, but ICICI at 4.30% versus HDFC's 3.27% enjoyed a wider spread. Asset quality. HDFC's GNPA of 1.24% versus ICICI's 1.58%, both strong by historical standards. Growth versus caution. HDFC's cautions loan growth and higher provisions show prudence. ICICI's steadier growth and higher NII highlights slightly more aggressive lending. What investors should watch. Loan deposit mix. Continued deposit growth outpacing loans could further squeeze margins. Provision trends. Watch if provisions normalize or spike, potential bad loan signal. RBI's December rate cut could boost loan demand but pressure NIM further. So what it means for you and market. Bank stocks outlook. Both banks are fundamentally strong. HDFC offers stability and superior asset quality. ICICI offers higher margins and steady growth. Private banking sector at its healthiest. Low bad loans, strong capital and steady earnings. Healthy bank results suggest India's economy is holding up, supporting consumption, investment and credit growth. Risk ahead. Margin compression and potential increase in bad loans if economic growth slows significantly. To wrap it up, HDFC and ICICI delivered solid Q2 results with strengths in asset quality and core profitability, but both banks face margin pressure as deposit rates rise. Keep an eye on provisions, loan growth and RBI rate cuts to gauge the next leg of their performance. If you found this breakdown helpful, hit the like button and to Pragmatic Finance for more clear, concise market insights. See you next time.